All right, let's get into it. Today, we're going to talk about something that is totally shaking up the world of finance. It's the fascinating story of how technology, from super complex algorithms all the way down to simple automation, is completely rewriting the rules of Wall Street.
So get this, just astrology for men who are cufflinks. That quote, man, it just perfectly sums up the old way of thinking about investing, right? It was an industry that was once driven less by hard data and more by a good story and a powerful gut feeling.
Yeah, we're talking about Wall Street's human era. Think, the age of gut feelings and intuition. You know the type, these big, charismatic figures, probably with giant egos and even bigger watches.
You see, back then, investing really was seen as this human art form. You'd find a manager, and yeah, they'd look at the data, but the final decision, it almost always came down to a hunch. And you know what? Before the internet, that kind of worked. Information wasn't everywhere like it is now, so having a good story, an edge, was a huge deal.
But then, well, everything started to change. The machines showed up, and with them came what we now call the quant revolution. Suddenly, there's this totally new kind of investor on the scene. Let's call them the math nerds.
And this wasn't just a small change. No, this was a massive philosophical shift. The entire question changed. It went from, hey, is this a good company with a good story, to, okay, given all these variables, what's the most likely statistical outcome? It was a complete flip, from stories to pure, cold, hard numbers.
So, what exactly is quantitative investing? Well, to put it simply, it's all about using math and statistical models to figure out what trades to make. The whole point, the entire goal, is to take messy human stuff like emotion, gut feelings, all that intuition, and just get it out of the picture completely.
And if you want to talk about the absolute best, most legendary example of this in action, well, you have to talk about Renaissance Technologies, specifically their super secretive Medallion Fund, started by this brilliant mathematician, Jim Simons.
Okay, to really get how insane their success was, we need a baseline. Let's start with the legend himself, Warren Buffett. His average yearly return is around 19%. And let's be clear, that is incredible. We're talking about one of the greatest investors who ever lived.
Okay, you ready for this? The Medallion Fund's average yearly return before they took out their fees was over 60%. Just let that sink in. It's a number that's so wild it doesn't even seem real. It totally shattered what anyone thought was even possible in investing.
So what does that difference actually look like in real money? Let's say you invested 10 grand for 20 years. With Buffett's amazing 19%, you'd end up with about $324,000. Not bad at all. But with the Medallion Fund's returns, you'd have over $7 million. The difference is just, it's absolutely staggering.
Okay, so you've got the quants completely changing the game for the big money institutional investors. But at the same time, there was this whole other disruption happening for, regular people. And this is where the robo-advisor finally comes into the picture. They were showing up to solve a completely different kind of problem.
So what was that problem? Well, the data started to come out, and it wasn't pretty. It turned out that most human fund managers, they weren't actually beating the market. In fact, a shocking 90% of them, year after year, couldn't even keep up with the market's average performance.
So, you can imagine regular investors started looking at this and thinking, wait a second, why am I paying these high fees for someone to underperform? It was a pretty logical question, right? And the solution was beautifully simple. People said, forget trying to find the needle in the haystack, I'm just going to buy the whole haystack. And just like that, you have the huge rise of low-cost, passive index funds. But here's the thing. Even if you're just buying the whole market, you still need to do stuff. The important but kind of boring tasks. Things like making sure your assets are allocated correctly, rebalancing your portfolio every so often, optimizing for taxes. All that crucial but, let's be honest, tedious work.
And that is the exact gap that robo-advisors jumped into. And man, did they take off. Just look at the growth. The money they manage went from $187 billion to almost $3 trillion in just 6 years. Why? Because they automated all of that boring stuff and they did it for way, way cheaper.
Okay, but this is where a lot of people get confused. They hear the word algorithm and they immediately think robo-advisors are like those crazy smart quant funds we were talking about. And they're just not. At all. It helps to think of it like this. They're Chef Boyardee, not a Michelin-starred chef.
The quant funds, they're the Michelin chef, right?
They're in the kitchen using these incredibly complex recipes, these algorithms to create something brand new and amazing that nobody's ever tasted before. Their goal is to outperform everyone. But robo-advisors, they're Chef Boyardee. They're just reliably and very cheaply making a standard, well-known meal. In this case, that meal is basic portfolio management.
So the key takeaway here is that a robo-advisor is just an automated digital platform. The key word is services. It uses algorithms to provide financial planning services with almost no human needing to be involved.
Look, their job isn't to find some secret alpha or beat the market. No way! Their job is to automate all that portfolio busywork. It's to give you low-cost market returns and, importantly, to replace the operational part of what a human advisor does. You know, the stuff that used to charge you 1% a year for, that they were probably just doing on a spreadsheet anyway.
All right, so let's pull this all together, because this is where it gets really interesting. The rise of the robo-advisor isn't just a story about investing. It's part of a much, much bigger story: the Great Disintermediation.
Think about it. For decades, what were you really paying a financial advisor for? We now know it probably wasn't for their amazing ability to beat the market. No, you were paying them for one single thing: access. That's it. Access to the markets, access to special investment products, and access to information that used to be really hard and really expensive to get.
And this isn't a new pattern. We've seen this play out over and over again. Remember travel agents? They basically vanished once online booking sites gave us all direct access to flights. What about stockbrokers who just placed your trades for you? Gone once online trading gave us all direct access to the market. Robo-advisors are just the next logical step in that exact same progression.
And that right there brings us to the single most important point of this entire story. It's a really powerful and, honestly, a pretty simple idea. When technology makes access cheap and easy, the middleman who used to sell you that access becomes obsolete. That is the fundamental shift we're watching happen right now.
So you see, this whole thing isn't really a story about whether robo-advisors are good or bad. It's a story about what happens when powerful technology finally crashes into an industry that hasn't changed in a really long time. So that kind of leaves us with a final question, one for you to think about. Have you ever used a robo-advisor? And maybe more importantly, would you trust one with your money?